If you've sold a buy-to-let property or a second home and made a profit, there's a deadline most people don't hear about until it's too late. If you're a UK resident and capital gains tax is due, you normally have to report the sale and pay an estimated amount within 60 days of completion. Not your self-assessment deadline, 60 days. This isn't about every sale. For a UK resident, the 60-day return normally applies only where capital gains tax is actually due, after allowable costs, reliefs, losses, and any annual exempt amount. And simply inheriting a property doesn't create a capital gains tax bill. Tax may arise if you later sell it for more than its probate value, again after allowable costs, reliefs, losses, and any annual exempt amount. Miss the deadline once it applies, and a £100 penalty lands automatically, with more following the longer it drags on. Stick around because later I'll show you something most guides leave out completely. When the final figures aren't available yet, HMRC allows you to use a reasonable estimate. Welcome back to Money Under the Microscope, helping you make finance clear. I'm a chartered financial planner, advising clients since 2016. Here's the trap an accountant would spot immediately. The 60-day clock starts from completion, when the sale actually finishes and the new owner gets the keys. But for capital gains tax, the disposal itself is normally dated from a different moment, the day unconditional contracts were exchanged. That matters because exchange and completion can fall in different tax years. If you exchange unconditional contracts in March and complete in April, the gain normally belongs to the earlier tax year, even though your 60 days only start ticking once completion happens. Get the wrong year's rates and allowances, and your workings out could be wrong before you even started. So, what actually gets taxed? Not your sale price, not your mortgage. Broadly, it's your sale proceeds minus what you paid for the property, minus buying and selling costs like legal fees, minus any genuine capital improvements, like an extension, not a repaint. If you're entitled to the capital gains tax annual exempt amount, it's £3,000 for 2026-27. That's one allowance across all gains for the whole tax year, not £3,000 for every property you sell. What's left is taxed at 18% for any amount that sits inside your unused basic rate income tax band and 24% above that. Here's a real example. Say your taxable income is £20,000 and your taxable gain after the allowance is £49,600. That leaves £17,700 of the basic rate band unused. You'd pay 18% on that £17,700 and 24% on the remaining £31,900. That's £3,186 plus £7,656, a total bill of £10,842. And because the 60-day return often has to happen before the tax year even ends, you may have to estimate your full year income to work out that split. Then correct it later if it turns out to be wrong. Hey guys, just a quick interruption. If you're finding this useful, there's a quick way to support the channel. Hit the subscribe button. It costs nothing and it really helps Money Under the Microscope reach more people. Right, let's get back to the video. Two reliefs can bring that bill down, but one of them is far more limited than people assume. If the property was genuinely your only main home at some point, you may get private residence relief for the qualifying period you lived there, and the final 9 months of ownership will normally count as a qualifying period, even if you'd already moved out. And then there's a letting relief. A lot of landlords remember this from years ago as a much bigger relief than it is today. Under the current rules, it only applies if part of the house was let while you were still living in another part of it at the same time. A lodger, essentially. If you moved out and let the whole property, you don't qualify for letting relief on those years at all. A pure buy-to-let that you've never lived in will not normally qualify for either of these reliefs. A couple of things worth knowing before you sell. If you're a non-UK resident for tax purposes, the reporting rule is wider. You have to report every direct sale of UK property within 60 days, even if no tax is due at all. And if you do miss the deadline, it starts with a £100 penalty. Leave it longer and daily charges, then a further penalty worth 5% of the tax or £300, whichever's more, can follow at 6 months and again at 12. On top of that, interest bills on whatever you still owe at HMRC's prevailing rate. That rate is linked to the Bank of England base rate and can change, so don't assume it's whatever you last heard. As promised, here's the bit most guides skip. If you don't yet know every final figure, your 60-day return can use a reasonable estimate based on what you know at the time. If that estimate later changes materially, you may be able to amend the property return. If you're required to file self-assessment, the final figures are dealt with there instead. That could leave more tax to pay or mean you need to claim a repayment. So if you're worried about having every final number available within 60 days, you don't need to panic. The estimate still has to be reasonable, but reasonable and timely beats perfect and late. So, sell a buy-to-let or second home, and if capital gains tax is due, you've got 60 days from completion to report and pay, even though the tax year itself is set by the date you exchange contracts. Private residence relief and letting relief can help, but letting relief only if you shared the home with a tenant. And where the final figures aren't yet available, your first submission can use a reasonable estimate. If this channel helps, hit the subscribe button. I'm Money Under the Microscope, and I'll see you on the next one.